Hey everybody, Dr. Richard Smith here with Cycles TV. Good to be with you all, and a little change up in the schedule, which is that Lars and I are going to be alternating Mondays now at this time slot. So we have consistent weekly deliveries of our best insights for the Cycles community here on YouTube and Cycles TV. And we can work our travel schedules around it and make sure that we've always got something for you consistently at this time slot. So a little change up going forward, but I think it's going to work great. So thanks for working with us and your patience through all this. Speaking of things Lars and I are working on, the Cycles in the City conference is now just a few weeks away. And there are literally just a handful of seats, I think 5 or less left for what is shaping up to be truly an extraordinary event. I am extraordinarily excited about this event. I can assure you that what I'm personally going to be bringing to the event will be worth the price of admission by itself. I've really been working hard on what I think are some game-changing insights into how we should understand cycles, what cycles are, what the reality of cycles is, and how to go about doing cycle analysis in the most effective way. And I'm just one of the speakers there out of a really mind-blowing lineup of speakers. And between the speakers and the staff, you know, there's really only about 70, 75 total seats available. And we're down to just 5 or less, one hand. So if you are thinking about it at all, please do come. Please get your seat now. And you don't want to miss it. I promise it's going to be fantastic. So with that as preamble, I continue to think about the way that cycles analysis was done by our predecessors, particularly by Dewey, and what was he doing, you know, looking at cycles across different time series and why, right? Looking for common cycles, what he called cycle synchronies. This is the Japanese version of Dewey's book over here. And in Dewey's book, Cycles, the Mysterious Forces That Trigger Events, when you look in the back, you'll see lots of charts of cycles across seemingly unrelated phenomenon that are of similar periods and peaking and troughing at the same time. That's always been very intriguing to me, but a little bit mysterious because that's really not the way we do cycles analysis today. And but what I've come to really understand more and more is that it is very important what cycles are showing up across different phenomena. Now, mostly here on Cycles TV, we've been focused on markets. All markets are connected in today's financialized world. So it's not like you're looking at, you know, tree rings versus sunspots. You know, everything is a little more constrained, but yet there are differences within asset classes, within markets. Liquidity, capital flows, all ultimately end up kind of being the pool from which asset allocation is done. I've been thinking a lot lately, you know, what is the analog of gravity in the markets? If gravity is what's operating through bodies to influence tides, for example, as we've been studying, is there an analogy for something akin to gravity in markets operating through asset classes to produce the market tides? Liquidity is obviously a good one that comes to mind, but this is a work in progress. And if you really want the big reveal, you're going to have to come to Cycles in the City or wait a little bit longer. But that's kind of the direction of my thinking and why today, you know, I chose this title of kind of, you know, the hidden hand, right? The connection of what's going on behind different markets, right? What are the connections between different what cycles do we see in different markets? What What phases do we see in different markets, et cetera. So again, this is all an evolving, developing direction. So I'm still working on it. And but you're going to get a little taste of what that is today. So with that, without further ado, I'll stop talking and we'll start looking at some charts. I'm going to do a quick overview of the things I usually look at, about what's going on with the big picture, and then we'll get into some markets and look across different asset classes, see what we can see. Let's go. All right, so for starters here, just the usual check-in about what's going on with the Federal Reserve here primarily, right? So the SOFR, the standard overnight financing rate, this is a market rate, not a Federal Reserve rate, but the market right now, for basically overnight loans that are backed by short-term treasuries, is paying about 3.64% or charging 3.64%. There's a very strong cycle in here, but I'm not really applying cycle analysis here in particular. We'll see if this plays out or not. The cycle's quite strong. It's basically a 1-year cycle, 257 trading days, almost 1 year exactly. But I don't think that's the most important thing that we're looking at here. The most important thing is the standard overnight financing rate, currently, flatlining at about 3.64%, maybe waffling up and down a little bit, but not really showing stress for treasuries as collateral, right? That's a big theme that we've developed over the past year, that treasuries are really the collateral for the global financial system. And basically overnight financing backed by treasuries is not showing any red flags right now. The interest rate from the Fed, the comparable interest rate from the Fed, the IORB interest rate on reserve balances, 3.65, also just flatlining, right? And you want the standard overnight financing rate about 3.64, and the Fed's analog of that, the interest rate on reserve balances, about 3.65. Now, markets are not putting their reserve balances into the Fed. The money market funds are not putting their reserve balances in the Federal Reserve. And we'll talk more about that in a minute. But basically, the money market funds are still soaring. Retail is pouring money into money market funds, and the money market funds are just buying treasuries directly instead of depositing their dollars at the Fed and getting paid the Fed's rate. So that's kind of where things are at. The MOVE index, the bond volatility index, right? Also very strong cycle here at 124 days. But, the cycles haven't really meant that much coming into here. And the main thing is that the bond volatility is still pretty subdued historically. And yes, we had this big spike, but it's come off quite sharply. And let's see here. I can put the CRSI and the swing momentum on here. Maybe we'll get increased bond volatility in the next little bit, but it's not really looking like it. The option adjusted spreads, another kind of indicator of risk in the lending space, in the credit space, and also not showing any big red flags right now. So things are pretty calm in spite of what it may feel like in terms of kind of treasuries as collateral, and the the wheels of the global financial system are still on the car. They're not coming off the car. This is the Fed's balance sheet. And, we've noticed there's been some more quantitative easing here over the course of 2026, right? When the Fed said, well, we can't just keep not buying any treasuries, because if we do that, then there's going to be a problem, and Treasury isn't going to, and the rates on Treasuries are going to get too high. So they've been kind of covering, a little bit of the slack in the Treasury market. Nothing dramatic, but definitely not reducing the balance sheet anymore, and kind of adding to it a little bit. So that's kind of the big picture in terms of what's going on with the global financial system, which of course is very reliant on treasuries and now private credit in addition to public credit. Like I said, the wheels are not off the bus. Things are functioning more or less normally. All right, now let's look at some cycles, and we're going to look at the S&P 500, commodities, treasuries, emerging markets, gold, Bitcoin, real estate, and the dollar. See what we can see. We're going to start with weekly data. And we're going to also be using our new cycle consensus index. Again, this is still, Lars and I are still working on this. It will be officially released at Cycles in the City. So another big reveal for Cycles in the City that by itself is worth the price of admission. But very happy with how this is coming along, and definitely keeping an eye on it. But Lars covered the stocks in depth last week, US stock indices. And I don't think that today is, we're not going to spend a lot of time on the US stock indices because Lars covered them already. But certainly on the weekly data, we've got this 193. This is the 41, 42-month cycle, right? And also this 80-week cycle, both showing cycle headwinds, but momentum still pointing up on the weekly data. And when we get to that, in the daily data, we'll see that a little more clearly, that some of those cycle headwinds are manifesting a little bit more. So, but the weekly consensus score here is bearish with, the 193 and the 37. We put our cursor over the last data point here, both falling. And then on the bullish side, the 64 here, coming into a bottom. So overall consensus on the weekly data from the consensus score on the bearish side, including predominantly this 193 here being the big bear. All right, that's stocks on the weekly data. On the commodities, DBC here, we also see this 194 period cycle here. Interesting. And we see this 253. Okay, the 253 is on the bullish side, but I'm increasingly interested in looking at the cycles that are showing up across different asset classes. So here we have the 193 in SPY on the weekly data, and we also have this 194 on the weekly data in commodities, in DBC. So something to keep an eye on there. Pretty interesting. If we look at just the 253, right, it's still bullish. Momentum is certainly bullish on commodities. Although fading on the cycle swing momentum, but no sell signal here on the from the momentum on the commodities. Moving over to treasuries. TLT, so I think the average duration in treasuries in TLT is around 20 years. So it's not, somewhere in between the 10-year and the 30-year. We've got this 73-week cycle. Don't really see the 193 or 180-week cycle in here so much. This 240 is in play. I guess that's kind of in the neighborhood of the 250 that we saw over here in commodities, and not really so much in the S&P 500, but TLT, the 240 there, 392 way out here is a little too undefined and too long, frankly, but also this 73 here. So both these, oops, I don't need that. That's the CRSI and the cycle swing momentum here. Momentum pointing down and cycle swing momentum pointing down, and the two strong cycles with the best definition in the spectrum, best ranks, also showing further caution ahead for TLT. Emerging markets here, another one. Look at this, 197 showing up again. And momentum, obviously uber bullish, although not quite a new high here from the last momentum high. Big move, right? From what, 31 up to 64, 65. So 100% move from what? From 2023, right? Even just from in the past year, from 39 to 65, almost 100%. Not surprising that all these other cycles here are red. And we're at an extreme bearish headwinds from the cycles for emerging markets, but momentum still strong. And we're seeing that same 197, which I think we've seen now in commodities and in stocks. So all of those showing that same 197 cycle. Here's gold, or GLD, I should say. We've got particularly this 237 here, I think, which is also around that 240 for TLT. So gold and TLT sharing a common cycle there. Not so much the 197 if we look for that in gold. Not jumping off the charts. So that's an interesting one. And momentum definitely down for gold. And the cycles are just about as negative as you could get. Extreme bearish score of 80 now versus in emerging markets it was only 71. Bitcoin got the 182-week cycle. I'm sure Lars would call that the nominal. Well, that was 200, but 200 days, not weeks. We're looking at weekly data here. So interesting that Bitcoin's, in that kind of 41-month range there. Momentum definitely turning up. Even got a CRSI buy signal on the weekly #1 cycle. Right, and there's a 40-week and a 100-week. If we look at just the 40-week, which is what, about 200 days, that's the 200-day cycle there. On the bullish side. And real estate here. What are we seeing in real estate? 123. You got the 277. not really seeing the 180 to 200 week cycle here. And then lastly, the US dollar. So the US dollar, if we look at the major cycles, 125, 85, and 221, okay, all on the uber bearish side, bullish side, right? Extreme bullish of 80 now. So if we go back and look at all of them, kind of bearish on real estate consensus, Bitcoin kind of neutral, gold extreme bearish, emerging markets extreme bearish, TLT extreme bearish, DBC neutral, SPY bearish. So certainly on the weekly data, from a consensus score perspective, and also in many of the individual cycles, we are seeing that the US dollar is kind of the hidden hand, right? That is in opposition with all of the other markets except for commodities and Bitcoin. And Bitcoin has been behaving a little more like commodities lately than it has been like stocks. So all of that is interesting. The cycles here in the dollar. Yes, there's this 357 out here, and it's got decent definition for this long of a cycle, but particularly this kind of 221, although, you know, if you look at it, it's got, there's not a lot of, there's a lot of slope here, right? It's not a crisp edge. And you can kind of see the hint of a 180 to 190 cycle there. I wonder if we added a little more data here. Let me see. We can get a little more up. There we go. There's the 188 cycle there in the dollar. And we can see that it has been bullish for a little while. Obviously, the dollar has not soared. This is UUP in this case, but definitely adding a little more data crisped up that cycle there, that 41, 42 month cycle, right in that same spot that we got the SPY. We can add a couple 100 bars to all of these and see if things sharpen up a little more. Look at that, 187 there. DBC, let's add a couple 100 bars there. So got that 252. There's now the 186 there. Interesting. TLT. What happened there? Do we not have any more data? Oh, there it goes. Okay. Still kind of shortened up there, but still not seeing that 180, 190 week cycle in TLT. Emerging markets, we already had the 197 there. If we add a couple 100 more bars, just get a little more granularity. Oops, didn't get the data. There we go. And indeed, that does tighten things up even more. GLD closer to the TLT there. We can add a couple 100 bars here. Come on, give me the data. There we go. Now we're at 1,050 bars. So got that 246. Bitcoin, we already had the 182. I don't know if there's even, this is all the way back to 2014 already. So I don't know if there are another 200 weeks of data in Bitcoin. Let's see. Yeah, that's pretty much about it. That's all the data in Bitcoin. In fact, it's only 600 bars. So we'll just have to kind of leave Bitcoin out of this analysis or just stick with this 182-week cycle. And then real estate, this does go back for a while. Let's see if we can get a couple hundred more bars out of the data here. And seeing about that 253 still. So the picture's getting kind of clear, right? We've got primarily this 188-week cycle in the dollar. And we can kind of couple that with, let's put TLT and GLD together because they're more in that 230 to 250 range for their main cycles. Okay, but the dollar here, 188 weeks and bullish. Emerging markets, 186 weeks, bearish. Commodities, 186 weeks, early bearish. So emerging markets kind of leading the commodities in terms of the cycles. SPY also 187 and bearish. So very interesting how we're seeing the same length cycle showing up across multiple different assets. And that's telling us something about the coupling of these assets. So the dollar, commodities, stocks, commodities, emerging markets, and the dollar all really kind of centered around this 188-week cycle. Now, I know that the cycles haven't really been changing the trend, okay, right? So stock market's going up, even though the cycles have been pointing down. We'll see about commodities. It's still early. And emerging markets have been doing the same thing that the stocks have done. And the dollar, even though it's had a bullish cycle, has not been responding to the cycle yet. The main thing I'm pointing out is that we're seeing this 185, 190-week cycle across these four assets. And then with TLT and gold, it's more this 246-week, 234, 246 week cycle with TLT kind of in the down phase and gold in the topping phase. So that suggests to me that, gold and TLT are more, something similar is driving those two. And then the dollar, emerging markets, commodities, and the S&P 500 are collectively responding to something together, right? Responding to something together. And that is what the kinds of questions that Dewey and others in our history started out asking, right? What's happening across different phenomena, in this case, different asset classes, all within the common arena, I guess, of markets, which all involve capital, right? Capital markets. So obviously capital is flowing between these different asset classes, but I really think starting to look at cycles this way opens the door to new insights from understanding how markets work, and to see, particularly this 187-week cycle showing up in stocks, commodities, emerging markets, and the dollar is something that we need to be paying attention to going forward, right? So certainly keeping an eye on the dollar. It's just interesting that the dollar isn't as connected, if you will, to gold as we've kind of historically understood it to be. and then how gold and TLT are also seem to have similar cycles. And then we can start to look, maybe next time at the phase relationships between these similar cycles showing up across different asset classes. All right, so let's quickly look at what's going on in the daily data. So we're going to just drop down to the daily data on, in this case, the S&P 500, right? So got a couple of strong cycles there. I can just add a couple hundred more bars, get us out to 1,050, get a little more definition around some of these. Obviously, this 305 and 120. DBC. Commodities. Okay, wow. Interesting. 160 and 320. Don't get much more perfect than that. Emerging markets. And the dollar. All right, so drilling down to the daily data here, just reviewing S&P 500. Certainly seeing that 120 and 80 day cycles. Momentum up in the cyclic RSI, fading in the cycle swing momentum. Very clear on the spectrum here, but a little more life left in the daily cycles and momentum pointing up, but the cycle swing momentum definitely looking less inspiring. And commodities, momentum. Got a 160 and a 320 here. That is about the cleanest cycle you're going to ever see in a major asset class. And hasn't yet exerted its influence. And then also here, we see the 121 cycle in there too, which we saw in stocks as well. Emerging markets, you got the 109 there. Very good definition. And also the 79. So that's interesting. Still plenty of cycle strength there and decent support for momentum. And in the dollar, not as clear that the connection to the dollar on the daily data is as strong as we saw it in the weekly data. So let's see, we've got the 87 here and the 109. I guess we did see the 109 also in where was that? In emerging markets there, right? So 109 and around 80. And in the dollar, we have 87 and 109. But we don't really see these 286 and 196 as clearly. Yeah, there's a 300. That's pretty unique in commodities. Yeah, okay. So a little less clarity on the daily data. But again, we see, stocks on the bullish side, commodities, momentum still strong, topping a little bit, emerging markets, momentum still strong, cycles got some life left in them, and then the dollar looking weaker. So again, kind of dollar versus stocks, commodities, and emerging markets, a coupling there for sure. So that's really what I got for today. Let me see if that raised any questions for you. But continuing to dig deeper into how do we study cycles, not just within a single time series, but how do we study cycles across different asset classes and ultimately different phenomena as well, which is what you start to wonder about when you get into the archives of the FSC, which I have had the privilege of being able to do, and I'll be sharing more of that in the weeks and months to come. So I think this is a very interesting and complementary approach to the way that we've been doing cycle analysis. And I continue to think that this is a rich vein for us to explore, to better understand cycles and the role that they play in our world, and what we can learn about markets from studying cycles. And the main thing, my kind of takeaway right now is that obviously the dollar and on one side, and then, stocks, commodities, and emerging markets on the other side. Those things are all connected. And the dollar is kind of the hidden hand that is the most attuned to whatever is driving that collection of assets. And then we also have treasuries and gold, which are also showing some similar cycles. So what might be driving treasuries and gold that is not driving the dollar, commodities, stocks, and emerging markets in the same way? Are there some bundles there? Is there something different going on with treasury and gold than there is in the dollar, stocks, commodities, and emerging markets? These are the kinds of questions I'm really excited about, and spending a lot of time trying to understand better so that we can see things closer to what they really are, which is what I'm continue to be very excited to share with you all, particularly at Cycles in the City. And then following Cycles in the City, more here as well. So let's see. Earl, Treasury and Federal Reserve coordinating control of U.S. dollar. I expect announcement of USD swap with Japan in the near term. What do you understand is the predominant cycle of the year? Great question, Earl. Let's take a look at the yen, because there was a major move in the yen, some hints of intervention from the Bank of Japan. So let's see, there must be a ticker for Yahoo Finance for the yen. I guess we could just use the futures. I don't know if there's an ETF for the yen, but we'll just use the futures. I think it's markets, currencies. There's JPY equals X, or in futures, guess they don't have. Yeah, all right, we'll just use JPY equals X. JPY equals X. All right, so here's the yen. And we were going back a couple hundred extra bars here. All right, that was 850. So let's go back to 1,050, which is what we were doing in the other weekly assets. A little muddled here, but certainly a clean spike here at 49 weeks, 50 weeks, right? Pretty close to a year. But not really seeing the same cycles, not seeing that 188, 185, 190 week cycle showing up in the yen, which is interesting. And let's see if we do look at the daily data. Right, here was this big move in the yen from 160 down to 157. And definitely seeing this 187 and the 95 week cycle. Let's add a couple hundred bars there. That's only 850 bars. So all right, so got this 146, 206, 92. All kind of bottoming, but momentum still pointing down. And not really seeing the same cycles. What do we got here in the dollar? 196, 286, 87. And then here in the yen, 206, 146. It's just interesting that the cycles aren't more similar than you think they might be. 196, I guess the 196 and 206 aren't that far apart. Yeah. So cycle-wise, looking like a bottom on the daily data, but momentum definitely not confirming that bottom. So I'd watch out there for trying to catch a falling knife. But thank you, Earl, for bringing that one to our attention, and definitely something to keep an eye on there going forward. All right, folks. Thank you so much. And let's see. Franz, it's all about the bond market. I think it has a lot to do with treasuries, for sure. But more on that next time. All right. Thank you so much, everybody. I'll see you again in a couple weeks. Lars will be back next week. And again, just a few spots left for cycles in the city. So if you have any desire to be there and you can be there, now's the time. Hope to see you there. Bye-bye.
Cycles matter because they show us the future. Nothing else shows us a future path. Nothing that I've ever found in over 60 years of doing this.
The foundation is bigger than markets, right? It started out bigger than markets. It's still bigger than markets. It's bigger than us.
There is no such thing as a black swan. It is merely a cycle that was not forecast or anticipated.
To me, it's huge. If I can get a glimpse of the future, just a little bit of the future, I'm way ahead.
I think that the Foundation for the Study of Cycles has a role to play in both bringing technology to the world, but also really emphasizing agency and human agency.